Life can get hectic when you start a family, but Which can help you make confident decisions from improving your home to financial planning. We'll make sure you're prepared. Whether you're looking to reduce your household bills, seeking advice around your child's health, or want to find our best buys for your new home, Which has got you covered. Use our expert advice to make the right choices for you and your growing family by visiting which.co.uk/growing family. That's where you'll find everything you need to make confident decisions and have peace of mind that all the advice you're getting is 100% independent. So to find out more, just head to which.co.uk/growing family.
Hello and welcome to the Which Money Shorts podcast. I'm the host of the Which Money podcast, Lucia Ariano, here to bring you a taste of some of the best money advice taken straight from the Which Money magazine. This week we're taking a look at the inner workings of the Bank of England, specifically with how interest rates are set. This article was originally written by Sam Richardson. All eyes will be on Rachel Reeves on the 30th of October as she delivers her first budget as Chancellor. But if you have a mortgage or are living off savings, the decisions made on Threadneedle Street are just as important as those at Westminster. That's because a slight shift in the Bank of England base rate could make a big difference to your household budget. Between 2009 and 2016, the base rate didn't move from its then record low of 0.5%. But between December 2021 and August 2023, it leapt from 0.1% to 5.25%. In retrospect, this wasn't fast enough. Repeatedly, the Bank of England predicted inflation would abate, yet it continued to rise. The result has been a longer and more painful period of high interest rates than expected. You can't vote on the base rate or the people that set it, yet they can influence the economy far more than most MPs. Governor Andrew Bailey has already outlasted 3 prime ministers and will be in his post until 2028. So how do they make their decisions, and what's next for interest rates? The objective of the base rate is to keep consumer price inflation at 2%. This target is set by the government to stop prices from jumping without putting people off spending because they're waiting for prices to fall. The base rate determines the interest that the Bank of England pays to commercial banks that hold money in the Bank of England. This in turn affects the rate those banks pay or charge their customers. Increasing the base rate means that borrowing becomes more expensive, while saving becomes more rewarding. This then reduces spending, which slows down inflation. The Bank of England's laser-like focus on getting inflation to 2% can be jarring. While the base rate is set to help the economy in the long term, it can have a much more negative impact on individuals. An estimated 320,000 people have been pushed into poverty because of rising mortgage rates in recent years, the Institute for Fiscal Studies estimates. In 2022, the Bank of England managed to outrage trade unions after Andrew Bailey called for restraint in requests for pay rises, as well as the Tory government. When Liz Truss tried to spur the economy with tax cuts in her famous mini-budget, the Bank of England was slowing the economy by raising the base rate to fight inflation. Truss later blamed Bailey and the economic establishment for her downfall. Truss could do little, however, because the Bank of England is operationally independent and has been since 1998. Although the Treasury owns the Bank of England and a representative sits on the group that sets the base rate, the representative can't vote on what the base rate should be. Supporting the government's economic policy is among the secondary objectives, to which Labour has pledged to add fighting climate change. However, a House of Lords committee in late 2023 recommended curbing other objectives and focusing on financial stability. The base rate is set by the 9-strong Monetary Policy Committee, or MPC, which includes 4 members from outside the Bank of England. 8 times a year, they each nominate what they believe the base rate should be, and the majority's view determines what, if any, changes are made. Members don't represent specific groups or interests and instead vote based on their interpretation of economic data. You can read how each member voted online, which has led to some being named hawks for those who repeatedly opt for higher rates, or doves. When their fixed terms end, they're either replaced or reappointed. Hawks and doves aside, it can be difficult to discern the differences between MPC members, given they're all current or ex-regulators, economists or economics advisors. Indeed, last year's Lord report warned of a perceived lack of intellectual diversity in many central banks, including the Bank of England. This lack of diversity, the Lord said, meant not enough people challenged the MPC's assumption in 2020 and 2021 that high inflation was temporary, when in fact the rise had just begun. So what influences bank decisions? For an idea of the factors that feed into the MPC's decisions, you can look at the minutes of their meetings. In June, for example, they started by comparing the UK's economic growth with other countries, particularly the US, and reviewing the actions of Bank of England equivalents such as the US Federal Reserve and European Central Bank. The MPC also examined statistics on household consumption, household investment, business investment and employment trends. It considered various measures of inflation, separating price rises for food and non-alcoholic beverages, core goods, services and energy. Much of this information comes from the Office for National Statistics, but the Bank of England also does its own research. It runs 12 agencies spread across the UK, and agents talk to local businesses and community organisations to understand local conditions. It uses software to model what this data means for inflation. This software was roundly criticised by a review into the bank's failure to forecast rising inflation, published in April this year. It warned that some key software is out of date and lacks important functionality, and that its central economic model, known as Compass, should be replaced or at a minimum thoroughly revamped. It also called for changes to staff management and for the Bank of England to publish alternative scenarios to help the public understand its decisions. When will rates fall further? Well, in June, inflation finally returned to its 2% target, the lowest level in 3 years. But the Bank of England didn't cut the base rate until August, and then by just 0.25 percentage points. This narrow cut only just sneaked through, with MPC members voting 5-4 in favour. The MPC acknowledged both services, consumer price inflation and earnings growth had fallen, but it cautioned there's a risk that inflationary pressures will prove more enduring in the medium term. These include economic growth and relatively low unemployment. In fact, the MPC predicted inflation would rise to 2.75% as winter approaches, due to higher energy bills. Only in 2025 and 2026 is it expected to fall below target. While markets expect the base rate to be cut again this year, the MPC is more circumspect. It has merely promised to monitor closely the risks of inflation persistence. The economy, in short, is not out of the woods yet, which means the decision makers at the Bank of England will remain under intense scrutiny. Thank you to Sam Richardson for that original article taken from the October edition of the Which Money magazine. If you want to subscribe and get the magazine delivered directly to your door, click the link in the description of today's show. For even more expert money advice, subscribe to our free newsletter, and don't forget to tune in to our weekly money podcast with new episodes every Friday. This episode was produced and edited by Romana Yassim. I'll see you next time. Goodbye.
Next time you need to get work done on your home, or your car, or your garden, make sure you choose a trader you can trust. And don't just choose any trader, choose a Which trusted trader. Our trading standards professionals only endorse traders who've passed our rigorous assessment that includes credit reports, customer satisfaction surveys, reference checks, and interviews. When we say a trader's good enough to display our Which trusted trader logo, you can trust us. But don't take our word for it. Search Which Trusted Traders online to see our directory of around 4,000 traders. Every customer review you read there is verified genuine by our moderators, so you can choose with confidence. To find a local trader you can trust, search Which Trusted Traders or go to which.co.uk/traders. That's which.co.uk/traders. Everybody needs a trader they can trust.